I'm excited to do this webinar. It is an interesting time that we're living in. Let's put it that way. So lots of interesting things to unpack. What I'm be talking about today is how the global events and what's going on in our world is impacting mortgage rates in Canada, and of course how it's impacting our economy and in particular our real estate market. So I'm going to get into a lot of things today, and a couple cool things that were very interesting to me that I learned when I was putting all this together. So getting into it, let's dive into the key thing that is obviously the most impactful item that we're dealing with right now, and that is the war in Iran. It's a very interesting situation that we're dealing with. There's lots of moving parts, and it has definitely had a large impact on the current expectations with regards to interest rates and the economy here in British Columbia and Canada. But there's a lot of things to unpack here. I do want to first talk about, in general, the impacts that a war usually has on worldwide economies. So what you're usually going to find is that in general, worldwide, so for countries that are not in a direct combatant in the war itself, it often generates slower growth, and that usually is because of less trade due to sanctions. So in general, if free trade is not as free, then you're going to see that that usually does slow down growth for countries internationally. Now, in general, Canada doesn't do a lot of trade with Iran itself, and so it may not impact Canada as much on the growth side of things. And so, in general, it can affect worldwide economies, but in this war in particular, perhaps not as impactful as other things. Higher inflation. Now, this is something that it definitely does have an impact, and we'll get into that in a little bit. But higher inflation is generally a factor. Usually, when you're seeing sanctions come into play, that usually is restricting the supply of goods traveling around the world. We saw that with the war in Ukraine. We've seen that with a number of different wars, where effectively it starts to constrain supply, and that usually pushes inflation up. And already, of course, most of the world is right on the cusp of trying to manage inflation. So this is, of course, top of mind. And then, of course, you have higher volatility, and so ensuring that that we understand like what that means for us and what that how that affects our markets, etc. Higher volatility is something that we need to be mindful of, because what happens in global markets, and especially the bond market, which we'll get into a little bit, and how that affects fixed rates, but you will find that higher volatility generally increases the premium or risk premium that is being charged. And so when there is a risk premium being attached to things, all of a sudden you'll find that when bond traders are packaging up mortgages together and selling them out the back door, which is effectively how mortgage rates are determined, there'll be potentially a higher risk premium because of the volatility of these assets, in particular bond yields. So in general, we find that with higher volatility, usually volatility is priced into the market. And in general, even if the bond rates were flat, which they haven't been, by the way, spoiler alert, even if they were flat, it often causes mortgage rates to go up ever so slightly. So in general, you're going to find these types of things are factors in worldwide events like wars. Let's dive into this specific situation and circumstance and look at what we are dealing with. Most of this war in Iran is going to come to down this spot here, which is the Strait of Hormuz. Interestingly, about 20 to 30% of all global oil exports are coming out of this area, and that's because you have all of these major oil exporters all needing to travel through this very narrow passage. I think when I was looking up this information, I think it's only about 30 kilometers wide. And of that, I don't know if that's the 30 kilometers that that is traversable, meaning it's not too close to the cliffs or whatnot. But long story short, it's a pretty narrow area, which makes it really easy to monitor. And Iran has been threatening and perhaps taking more action than this to say, hey, you know what, we're going to cause a lot of mayhem in this area. We're going to make it very difficult for ships to travel through this region, and that's one of the concerns that we're seeing right now, especially with 20 to 30% of oil exports coming from this particular area. Now, one of the things that I've definitely deep dived into and learned a lot more about, and I kind of knew that this was a factor already, but not nearly to the extent that I've now learned in the last couple of days, is really understanding the mechanics of this war, why it may be happening, and then starting to deep dive into something called the petrodollar. So the petrodollar is an interesting thing, and some of you may have heard of this before. But the petrodollar is effectively something that started it back in the 1970s. And what happened is the U.S. came in and actually started to support Saudi Arabia and said, "Hey, tell you what, there's a lot of civil or just unrest in general in the Middle East. Why don't we provide military support to you, and in return, we will tag and basically connect all of their oil exports to the U.S. dollar." In addition to this, it also helped Saudi Arabia at the time with massive currency influxes or changes, and so in general, being able to grab hold of a different type of currency than your own sometimes can stabilize your areas or your markets. We saw this as an example in Venezuela. When their inflation started to go through the roof, they started to try to look at, okay, maybe we'll use the US dollar. That's not the greatest one to use. In fact, Venezuela was even trying to use Bitcoin and other cryptocurrency in order to tether their currency so that they didn't have massive changes in currency values. And so at the time, Saudi Arabia thought, hey, this would be a good idea to give us some more military security. And for the US, it gave them an opportunity to say, okay, great. Now this oil is going to be traded in U.S. dollars. Now, what ended up happening is Saudi Arabia was the largest country of that grouping, and so then all of the other countries followed suit too. And so it became the petrodollar because all of a sudden all of this oil was tied to the U.S. dollar and started to become traded in USD. It actually is one of the reasons that reinforced the U.S. dollars being what's called their reserve currency. So it's a currency that's often used by other countries in order to conduct trade. Now, all of this is really important because there's a lot of factors when you're looking at what the petrodollar means to the U.S. economy and then what it means to the Canadian economy. So long story short, what happens is the U.S. buys oil from Saudi Arabia or other countries like that in U.S. dollars. And then what's happening is the U.S. dollars or the Saudi Arabia or other countries are then paying for other services or other things in U.S. dollars to local contracts. And in many cases, what ends up happening is this money ends up getting funneled back into the U.S. And getting reinvested back into the U.S. Into other financial instruments or other financial assets. So if you really look at the relationship between the U.S. and Saudi Arabia and some other countries there, this is where you're going to see a lot of these connections and understand a bit more about why there's such a deep relationship between the U.S. and some of these Middle Eastern countries, and why the U.S. Tends to protect certain countries there and not protect others. But it's very interesting to see this recycling, they call it, of the U.S. dollar. And what effectively this is doing is it is strengthening the U.S. because they're buying oil, which is tagged or tied to the U.S., and then Saudi Arabia has to do something with all of this excess cash. They're a very rich country because of the oil, and now they have to reinvest it back somewhere. Well, they're already holding U.S. dollars. It makes sense to just invest in U.S. companies and effectively buy stocks in U.S. entities or whatnot. And this just recycles and puts the money back into the U.S. And then by having all this money re-enter the U.S., it allows the U.S. to have lower interest rates, and it allows them to raise more capital more easily. Now, not everybody is liking this situation, and one of the situations that's happening very recently, I was just reading something last night or this morning, can't remember now, but Iran is now saying, you know what? We're going to allow some ships to travel through the Strait of Hormuz, but only if the oil prices are tagged to the yuan, the Chinese currency, as opposed to the USD. And so one of the reasons that this is happening is a lot of countries are trying to get out of the petrodollar. And if you look at it, there's a group of countries called the BRICS. And these BRICS are basically a few countries that are trying to get together. And there's actually a lot more than the original, 5 or 6 that joined in. But they're effectively trying to say, hey, let's get out of the situation where the U.S. dollar is used for everything. As an example, when the war in Ukraine broke out, the U.S. actually said that Russia could no longer use the SWIFT, which is a way of wiring and moving money internationally, and it's basically one of the ways and the channels that's used to wire funds around the world. And of course, that's something that Russia doesn't like, and so one of the things that's starting to happen here is this BRICS entity is starting to become a little bit more robust and getting more traction. And this is something that is a major factor. So there's a lot of moving parts here with this war in Iran. It's not just as simple as Iran is looking at creating nukes and we need to destroy those and take care of that. That's often the language that's used in order to enter into other countries in many ways. But in this case, it may also have very significant economic impacts and implications. So with all these moving parts, what effect does this have on mortgage rates and the market in Canada and in British Columbia? Let's take a look at some of the major factors that we're always monitoring and following. So the first one is unemployment. You can see the unemployment rate in Canada has historically been higher than the U.S., and that's no different today. We're still plodding along at a higher unemployment rate than the U.S. But we did see actually in 2025, the economy in Canada is not actually doing that bad. Of course, we're going to see some ups and downs, but there's many moments where sometimes the jobs reports showed losses, but sometimes it also showed gains. So, as much as people are thinking and feeling like it's a tough market, we're not seeing a lot of unemployment as of now. At least the reported unemployment rate is not that high. And this is, of course, one of the data points that the government is looking at to figure out what do we do with rates. If unemployment is going up, then they may be inclined to lower interest rates to counterbalance that. The big one, of course, that we've been watching and following is the inflation. And this chart is good news, seeing that the inflation numbers are slowly coming down. The last inflation release that we saw, it's getting at that 2% level, which is really the target that the Bank of Canada is looking for. Now, the Bank of Canada is not going to just hit that 2% target and say, okay, great, we're done, we're good, and now we can lower rates or do whatever we need to do. The Bank of Canada feels like right now they're in the neutral rate zone. And so that means that if they're in the neutral zone, that where the rates are shouldn't be pushing and propelling inflation and growth, but it also shouldn't be, it shouldn't be pushing things up or down, basically. So they're thinking that that's kind of a neutral impact on the market here. So we're in an interesting spot. The government of Canada is thinking, maybe we'll watch and see what happens. The primary issue with inflation is that it can be very sticky. It can be difficult to get rid of. The major thing that they're looking at is the inflation that kind of came in the mid to late 70s and then persisted into the early 80s. That was something where they thought that they had the inflation under control, and then it kind of skyrocketed and frankly got a little out of control. A lot of it was due to oil and OPEC at that time, where all of a sudden a lot of the countries in the Middle East decided, you know what, we're not going to sell our oil and we're going to start to restrict supply, and that caused a massive amount of inflation back then. Now, when we look at it, as we're talking about inflation and what's happening, this is a big one, and this is changing the impact of what the expectations are for inflation moving forward, and therefore what expectation to be looking at for interest rates. And so we've been looking at this and looking at the chart here. Oil has been in the $60 to $70 range for quite some time, like quite a few years now, where it's been pretty steady there. And all of a sudden, we've seen a massive spike up. In fact, it hit almost $110 per barrel, which it hasn't been at in a very, very long time. And so this massive spike up and, a bit of a resettling in the last little while, we're now at a point where oil prices in a very short period of time have increased about 50% in just the last couple of weeks. Now, will things stay there? hard to say. And of course, when you see this kind of crazy volatility, markets can get a little bit wonky, a little bit crazy, and I'll show you the impact that we've seen on some of the markets in a second. But the war in Iran is definitely impacting oil, and oil is in a lot of things. It's in transit, transportation. It's in the production of things. It is a very important underlying foundational item that affects inflation everywhere. So what's going on? Bank of Canada is currently paused. They're in a situation where they're thinking, you know what, we're going to stay in this neutral zone and wait and see type of attitude. This morning, they announced no changes to the prime rate. So the prime rate will remain at 4.45%. The biggest thing that we've been seeing and noticing, however, is in the bond market, which is what impacts fixed rates. And so all of a sudden, just in the last little bit, we saw interest rates, spike up quite a bit. And so back around December, there was an uptick in interest rates, and then they started to actually come back down and started to settle in. And all of a sudden, just in the last couple of weeks, they shot up again, and they shot up about 0.4% over about a 2-week span. Very, very quick movement upwards. Now, we have noticed that they kind of came down a little bit and have been settling in the last couple of days, but really hard to say exactly what the impact will be. But when you see that kind of movement upwards in the bond market, is not good for fixed rates. We've seen a number of lenders increase their fixed rates, mainly due to the expectations that now oil prices have gone up. Inflation will be a thing. That means that especially long-term interest rates need to accommodate and come up in order to manage that. Now, one of the things I like to do is I like to look at the past, and this isn't a totally, a similar situation necessarily, but I pulled up a chart. So the war in Ukraine had recently restarted, I guess I should say, back in February of 2022. And so I pulled up a chart of where the bond market was in January of 2022. And so the bond market was sitting around, it closed on January 1st at 1.62%. Then what we saw is all of a sudden, if we fast forward to March, all of a sudden the interest rate closed at 2.75%. Pretty significant increase. Now, I will say this was also during early 2022. This is where the inflation scare started to really take off. And so it wasn't just the Russia-Ukraine conflict that was causing this, but it was definitely a factor. And so all of a sudden they saw, people were thinking, if Russia's going to war, there's going to be sanctions against Russian oil, and all of a sudden the oil supply is going to decrease. And what's going to happen there? It sounds very familiar, doesn't it? So there is a potential here, depending on how this conflict unfolds, especially if Iran takes drastic measures and i.e. shooting down a number of oil ships down in the Strait of Hormuz. We could be in a situation where there's a shortage of oil supply around the world, which would cause a large amount of inflation, which would not be good. So, given all that information, what should you do? What should you expect? How do you manage the situation? This chart is showing the forecast for where interest rates are expected to move, and so we're in a position where just in the last week or so, the expectations about the Bank of Canada moved from within about 12 months from 1 prime rate increase up to potentially 2 prime rate increases. So the expectation is still that during the course of 2026, unlikely to be an increase until very, very late. And so the market traders that are pricing this in are looking at maybe an increase in around December of 0.25%. But then another increase at some point early in 2027. And so maybe, as early as January, February or so. So they are starting to predict that the Bank of Canada might be up to 0.5% higher. It's right on the border of either 0.25% or 0.5%, but it's just edging a little bit more towards the 0.5% as of the last week or two because of this issue. And you can see that the interest rates for variable rates would be slowly increasing. So this variable rate, by the way, is showing like an expected discount off of prime that you could get for an owner-occupied home, and then what the changes to that variable rate would look like. Now, the flip side, you're also looking at for a owner-occupied 5-year fixed rate, what that looks like today, and then what that might look like in 12 months. And this is the biggest change and gap that I've seen in a very long time, because we've been watching and following this trend for a while. generally speaking, the market has been expecting that the fixed rates will go up about 0.2 or 0.25% per year for the next 5 years. Now, all of a sudden, this chart is showing a massive 0.6% increase to the fixed rates over just the next 12 months. That's a pretty significant jump. Now, I do think that there's a high volatility in the market right now. And I do think in general that the markets will settle and that gap will probably shrink a little bit. But if this is true, this is going to have really big implications for your mortgage and what you should be doing with it. So something that we have to monitor and follow with regards to what's happening with interest rates, and there is all of a sudden a larger expectation of higher rates moving forward, which is not good. Now, circling back to the petrodollar and the impacts that this would have, if we start to look at this whole issue, if this is true and if the petrodollar totally collapses or at least is significantly impacted, there would be some impacts to mortgage rates. We would definitely see quite a few different things change. The first and foremost is that fixed rates will be likely to rise, which we're starting to see the expectation that maybe we're going to see higher inflation and fixed rates would be higher. In particular, if the petrodollar crumbles or falls apart and oil is no longer traded in US dollars, this means that money will be leaving US, or at least it'll be harder for US to attract money, which means that they would have to increase their yields on their bonds and other instruments in order to attract money. That means that if the US bond rates are rising, Canada rates will likely also rise with it. They are suggesting, however, that there'd be less of a correlation between US yields and Canadian yields. So if the US yields go up by, let's say, 0.5%, Canada probably won't be another 0.5% themselves. It might be 0.25% or 0.2 or something like that. But just to note that there is an expectation that if the petrodollar collapses, this would be a likely outcome, which is US treasuries and bonds would go up for the yields. Canada would likely follow at some level. Now, on the flip side, for the variable rate, there's less certainty about what exactly would happen here. So a weaker US dollar may increase inflation. So one of the issues that we might see is there could be a circumstance where if the US dollar is getting weaker, then Canadians could buy more US goods and it might spur inflation a little bit. On the flip side, a US slowdown could also slow down Canada too. If US is buying less of our goods, which if you combine the tariff situation plus a weaker US dollar, meaning less investment into Canada, then that could cause the Bank of Canada to cut interest rates. And so this could go either way. We might see an economic slowdown, and that would cause the Bank of Canada to consider maybe making some cuts to the interest rates. Now, if we look at the real estate market itself, short term, there's going to be some impacts too. So short term, we would expect that house prices would probably come down a little bit if now all of a sudden the US is weaker, there's a little less money coming into Canada. Anybody that has a job that's related to selling to people that are in the US or has any relation in that way may see that there's going to be some kind of economic slowdown. So if you have an economic slowdown, you would expect you probably have slightly less demand. We'd also have rising interest rates due to the inflation if the petrodollar does collapse. Supply, this is an interesting one. So you'd likely see a construction slowdown. And we've already seen this in many major urban centers, particularly Vancouver, Toronto, et cetera, where the new construction starts has decreased and basically fallen off a cliff. Less developers are choosing to start new projects today because they just aren't economically feasible with the price of goods and labor. If there is a issue with the U.S., then we might see that all of a sudden the costs would rise a little bit on construction goods, and it may be less feasible to start construction, and so you see less new supply entering the market and getting started today. And so if that's happening, then you'd see rents would likely be increasing because there'd be less multifamily supply being built, which means slightly higher rents. It would probably take some time, however, for the rent factor to roll into the market and the economy. If you can look at this long term, we're going to see a bit of a different story. So if short term there's even less supply getting built than what we're dealing with right now, then house prices in the future would likely have a upward movement because eventually, if there's not enough supply to meet the demand long term, then house prices will eventually rise. With interest rates, they're expected that, hey, interest rates would probably rise to a certain level and then would probably stabilize at the new norm. And so if you go back to that chart I had a few slides ago, they saw massive increases short term, and then the interest rates would rise maybe ever so slightly moving forward, but most of the damage would be done in the first year or two. This is the big one, and this is the big concern for housing affordability. Is we are already talking about a major supply shortage coming around 2029 or 2030. It's being predicted by a number of economists who are looking at, hey, if this is the number of new product that's getting started and built today, we're going to have a massive shortage in a few years from now. And so if that does come to fruition, we will have a major crisis on our hands, most likely. And the prediction is that, especially in the condo market, where there's very little condos being built because there's a massive oversupply in many urban centers, there's basically nothing or very little getting started today. Fast forward 3 or 4 years when those will be getting finished, and all of a sudden there's no new product hitting the market. It could create a very large supply shortage, and it takes a very long time because the cycles are so long. You'll see that in condos, that 3 to 4 year cycle, where that's how long it takes to start and finish a project. It creates these long elastic bands that take a lot longer to work their way through the system. Whereas detached housing, for instance, can be started and finished within 12 to 24 months, depending on where exactly that the project is at. So very different timelines that are associated with this. And that means that we might see that although condos are projected to be weaker short term, there's also a very significant concern about where the supply will be for condos in 3 or 4 years. And then rents. If there's less new multifamily product or just in general units getting constructed, then there will be upward pressure on rents. So short term, I'm still thinking that we may still see a slight decrease because there's still a excess supply in general, especially in major urban centers like Vancouver and Toronto. It'll take some time for that product to get eaten up and occupied. So I still think short term we'll see some rents decreases, but again, longer term, if there's a lack of supply, then you'll see rents eventually increase. So what does this all mean for you? It means that fixed rates may rise more than expected, and we've already been expecting and following the economists' predictions of rising about 0.2 or 0.25% per year. But I must say that chart where they showed a 0.6% increase over 12 months, that was very high. There's a very large increase, more than what we've seen in quite some time. And I do think that expected increase will probably relax a little bit. Markets have a tendency to overcompensate or look at changes and say, "Oh my gosh, this is moving very quickly." I do think that will settle down. Now, if you do have a mortgage renewal in the next 2 years, it may be worth taking a look at whether it makes sense to break that mortgage. There will be a moment in time if you can secure a rate that may be at the trough and the low point in this rate cycle. It seems like rates had gone up quite considerably and now have come down. And if we're at a point where they're about to go up, it may make sense to get a rate hold now. And then if rates keep climbing, it may make sense to break the mortgage instead of waiting for 12 or 24 months to renew, especially if rates are 0.6% higher in 12 months. You'd almost certainly be in the money to break the mortgage and redo that. It's really tough because you don't know for sure about where rates are heading. But if you get a rate hold to hold it, you can have 4 months to observe which direction do rates go. Do they keep going up? Or do they settle and flatten out again because maybe the war in Iran gets settled or solved, or some other situation or circumstance pushes rates down? But it may be worth getting a rate hold just to see and monitor that, because if rates keep climbing, you'd be pretty inclined to break the mortgage early, pay the penalty to do so, but then get a nice low rate secured for 5 years. For the market, short term, I'm not expecting a very different outlook. I think that right now, a lot of people that are out in the market and in general, are looking for a deal. And I don't think that's really going to change a whole lot. There might be some job loss in certain areas or certain markets, in particular areas or demographics that are selling a lot to the U.S. Because if the U.S. does have a meltdown of that petrodollar, then that could impact people that do a lot of business with the U.S. I think the general market sentiment is already that the market is a bit weaker. No need to rush into something. On the flip side, I am finding that people that are thinking, there's a lot more supply. I can negotiate. I can find the property that I want. It's the right deal for me. And maybe the values, maybe you're buying not quite at the very low point, but very close to it. But maybe you can negotiate with that seller because you're the only buyer, perhaps. Maybe you can undercut the current pricing. And maybe that's putting you in a position that maybe the prices never quite get down to that point that you negotiated before they turn. I do think that a lot of people are sitting the sidelines waiting for the signal to go back and start looking again. And the signal usually is they need to know that they've hit the bottom. Well, the tough part is you don't know if you've hit the bottom until prices start to go up. So you probably, those people need to see that prices have gone up a couple months in a row. By that point, it does start to get into like an exponential chart in many cases where a lot of people all re-enter the market at the same time. And then you have people bidding over each other. Supply starts to shrink. There's less product available for you to buy. The ideal home for you is not available, and people tend to start to just say, "Okay, I just have to get something." And it's a more stressful market, to be honest, to be buying in that. And so I do find that some of our investors are coming back into the market and starting to say, maybe I'll sniff around and write some lowball offers. There's no need to jump in and buy the first thing that you see. So it'll be interesting to see what happens, but I don't think that the markets will have a significant impact. Maybe as an investor, what I might be looking at is which markets may have a more positive effect from this change. And it's possible that a province like Alberta might actually have a stronger foot to stand on. So if this issue in Iran gets more drastic, if there's a decoupling of the petrodollar, maybe a lower supply of oil worldwide, and oil prices are going up, that stands to probably benefit Alberta more than most of the other provinces in Canada. And so if I was an investor trying to figure out where to buy, that might be a market that I spend a little bit more time to do some more research on to see if maybe there's something there. And then the other flip side is I think that condos, it could be a good buy if you can get a good deal on it. You'd have to get a really good deal, and you have to know that you're probably waiting 3, 4, 5 years before the prices go up. So you'd have to know that you might not be feeling good about your investment for a few years. But if you can get a really good deal on a condo, then that might work. I've seen some buyers walk away from their whole deposit on pre-sale units, and so we've had some investors that bought the unit that just took all of the money from the investor that walked away, and they basically took the entire deposit and then used that to buy the unit. So there are opportunities where sometimes you can get into to something with where there's a massive decrease to the price that you have to pay for the unit. So if you wanted to learn more about whether refinancing may make sense for you, every situation is different. But if you wanted to understand if it may make sense, if you might be in the money to refinance, then reach out to us. We'll be happy to do an analysis for you. Brian would be happy to go through the spreadsheet and kind of work through that with you. And then, of course, for anybody that doesn't already have our book, Rockstar Real Estate Investing, reach out to us. If you send us an email and give us your mailing address, we'd be happy to put it in the mail for you. It's a book that's giving people the foundation of investing in real estate, how you make money in real estate, different opportunities, and different ways of thinking about it. And then, of course, if you have any questions, you can reach out to us and let us know. I'd love to open up for some questions now. So what I'll do is I'll take a look at the Q&A here. I don't think there's been any questions asked yet, but I'll open up for Q&A. And if anybody has any questions, then please feel free to shoot your questions in either the Q&A or the chat. I know there's a lot of things going on in the world right now, and I'll do my best to answer it as much as I can, but nobody has the answers. I think if I had the answers, I'd be sitting on a beach sipping margaritas somewhere. But I've done a bit of a deep dive on the petrodollar and what the impact that might have, because I think that was kind of interesting to learn more about. And not to say that the petrodollar is going to completely collapse, but I was interested to learn, well, what if that did happen? I'm wondering if this is one of those things where this might be a breaking point, or at least start to move and progress in that direction. So maybe not as drastic of a change or move as I mentioned in the presentation, but maybe you'll see micro movements of, okay, petrodollar is starting to not be as much of a thing, well, maybe that does cause some inflation, and maybe rates go up a little bit, and maybe we do see a bit of a weakening in the U.S. market too. So yeah, I'll open up for some questions. Any questions? There's a question here. So are lenders more reluctant to provide financing? There has been some changes. So I found that most of the changes have been as it pertains to commercial lending or business lending. So there's not been a lot of changes to residential lending. In general, lenders are pretty similar to what they were doing before, so not a huge change there. On the flip side, commercial lending or business lending has been more difficult. We've had a couple of clients that the banks are saying we just don't want to deal with you anymore, which is kind of drastic, but we've seen that. And a lot more restructuring on the business side we've been noticing. So myself and a number of other brokers that do commercial lending have been noticing that we've been busier with those types of applications. In particular, not even just new acquisitions, but even just restructuring existing companies and existing debts. Hey, Yuri. So question is, what is the average interest rate for commercial lending on multifamily buildings? So there's two different ways that you can finance multifamily. And so the first one is just a standard, it will be a standard way of getting financing called conventional financing. Usually commercial lending is somewhere around 5% or just a little bit over 5% right now. So in some cases, you can get rates that are lower than that. In general, finding that some banks are really competitive for like really short-term fixed rates, so like a 1 year, 2 year, 3 year fixed rate, something like that, are fairly low. And then the 5 years are generally in the mid fives, like 5.25% up to 5.5%, somewhere in that range. If you're getting to CMHC multifamily financing, then generally the rates are much lower than that. You'd be looking at probably in the high threes, or maybe as low as the mid threes, but probably somewhere in the high threes based on where the bond market is today. If you're getting CMHC insured multifamily, which is very strict or different, I should say, qualifications. So it's harder to get CMHC financing, but if you can get it, then the rates are lower. Hey, Jamie, question here is 5-year fixed or 3-year fixed? Since the rate seems to be going up, are we better off with 5? Yes, in theory, then, if rates are going up, then you would want to be leaning towards the 5, and that only is exacerbated with the current expectations. So we've been starting to shift more into the 5-year fixed, probably since, I think it's been about 3 months or so that we've started to shift that outlook. And it started back in January of 2025, but all of a sudden the inflation outlook for the world and then the future interest rates started to shift because of the whole tariff situation. Then it kind of settled in a little bit, and then the 3-year fix was competitive again. And now we're starting to find that recently, when you look at it and do the math based on the expectations of where rates will be in the future, the 5-year is projecting to outperform the 3. The one thing to keep in mind is that if you do break the mortgage early, often the 5-year, the penalties to break a 5-year fix can be more expensive than to break a 3-year fixed. So that's something that you'd want to keep in mind, is that interest rate differential penalty can be higher if you break the 5-year contract before it's up. Hey, Mira, if any lenders started tagging their lending rates to properties that might be subject to Indigenous land claims, good question. No, we have not seen that. Frankly, this whole Indigenous land claims thing is so new, so early. I don't think really anybody has a good handle of exactly what's going on with that. So nobody has really changed their tune or opinion on that as of now. But I'm very interested to see what happens in the near future. But as of now, no real changes that I've seen anyways due to this. Hey, Patty, is this a good time for first-time buyers to be looking for their first purchase? Do you have any advice for first-time buyers? So interestingly, in some ways, it is a good time to be a first-time buyer because it's a way less stressful market to be buying in, because you're casually looking. You can look at a property and like, not sure if that's the right fit for us. We're not sure what we want yet. And then you can circle back to that property 2 weeks later and it's probably still available. So in many ways, it's a friendlier first-time buyer market. It is hard to as a first-time buyer, often people want to feel like they've timed the market and bought at the low point, and the reality is nobody really knows where that low point is, and so mentally it can be tough to buy in this type of climate because of that, or at least tough to pull the trigger and actually take action on something. But it's much more casual to look, and so from that perspective, it's much better. Because if you look at the opposite of this kind of climate, if you're trying to buy in 2021, like every single property had multiple offers. Every single time, it's like, hey, we have an open house on Saturday. There's 100 people at the open house, and then they're taking offers on the Monday, and there's 20 competing offers, and you have to figure out what price you're going to write, and it has to be over the asking price. You're not really sure what. And so you find a home you like, you get excited, and then you realize there's 20 other bidders, and then you lose, and then you lose again, and you lose again. And so that process of losing out on homes that you're interested in over and over and over again can be really stressful and difficult. So, I think at the end of the day, if you're a first-time buyer, what I would suggest is it's a great time to be looking at properties and then getting an idea of what you like, and then not just buying the first place that you like, but taking your time, figuring out, yeah, we really like the area, we like this kind of property, and then you see the right home, you're like, that's the one, let's go in on it. And hopefully there's very few other people that are looking at it, and maybe you can even get a deal. We're finding that developers with brand new properties, they're willing to sell properties at a big discount, and condos in certain areas are also selling at a discount. So there are opportunities for sure for first-time buyers, or just anybody buying in general. Christine, hey Christine, if a developer is purchasing individual houses in a land assembly, would they be getting commercial financing for the purchases? Most likely. It is possible that you can get residential lending on each of them, but it's very difficult to qualify because a lot of the time these homes are really being purchased for their land value. And if you're buying homes based on the land value, it means that the house value is quite low. If the house value and therefore condition, square footage is also fairly low, then that means you probably aren't getting premium rents for it. So what ends up happening is it can be usually quite difficult for you to qualify to acquire those properties and get residential lending on it, because the debt coverage or debt servicing can be really, really tough. You might be buying a home for $1.5 million, or a few homes for $1.5 million, and they might only generate $3,000 a month in rent. Very difficult for your income to be high enough to service that. On the flip side, it's also difficult to get commercial lending on the land banking side. So you acquiring them and then achieving rezoning, and then eventually getting building permit, a building permit, and then eventually breaking ground. The banks really want to be in at the building permit stage and not much earlier, because really what we've seen is that the land holdings is where almost all of the losses for any lender, especially mortgage investment corporations like private lenders, the losses are all on the land side of things. And so a lot of them want the projects to be like shovel ready. So you're finding that even with private lenders, the costs and the ability to get financing for these types of properties can be more difficult. So it really depends on the situation. Sometimes we see it where people will buy, if there's a land assembly, there's a few investors, each person will buy one and get one residential mortgage each, and then wait until they have building permit, and then they'll combine everything into the company. But there's tax implications if you do it that way, property transfer tax, all these other things that can be a bit messy. So I do find everything can be very case by case, but as a general concept, a lot of people are trying to do commercial lending on this, or they are often getting forced into private lending if they have to, which is frankly a lot of people that are pre-building permit. I have another question in the chat here. So maybe a bit unrelated question. What have you heard about banks canceling lines of credit to customers? So I actually just saw something. So I've heard that Scotiabank has just sent out a number of letters to customers saying that they're reducing or canceling the line of credit limit that the borrower has. So this is very news to us. We just saw this a couple of days ago, that they're sending out letters. You have to understand that any line of credit account is called a running account, and what that means is that it is callable. They can call the loan at any time. We saw this in the past with, especially in the subprime crisis of 2008, unused lines of credit. The banks, when they give you a line of credit, they have to have money and capital available to lend to you whenever you want it, and that costs them money. And so what I think you're going to see, and what I'm thinking Scotia is doing right now, is they're doing this. They're reducing a certain segment of the market's lines of credits, for number one, reducing their risk. The lower that their risk profile in their portfolio is, the less money that they have to have set aside, and so it really helps with their government compliance and making sure they have enough assets in the books. It also can improve profitability. So for people that have low credit, have a lot of credit that's available to them, these are the targets that banks are going to look at. So yes, we have heard. I know Scotia is doing this as of right now. And so I don't have a lot of details on it because we just heard about this just a couple of days ago and are starting to see that customers are getting letters. And so yeah, it could be very interesting. So your follow-up question here is, would that mean that they can cancel the HELOCs when refinancing? When you're renewing, they may decide to reduce it, but even during the term, they don't have to continue to offer the line of credit. What I don't think will happen as much, though, if you have an outstanding balance on it, I don't think they're going to go to people and say, hey, you now owe us this money and you have to pay us in 30 days or else. I think that's unlikely they would do that, especially if you're making your payments on time. But I'm not so sure exactly what this would look like. It could get nasty if things get really bad. So your question is, my understanding when I apply for a commercial mortgage, it doesn't matter what my personal income, but rather what the income from the building is. In this case, does it matter if it's 2 million or 10 million as long as my debt servicing ratio is over 1? So a couple of things to look at here. So first of all, the debt servicing or debt coverage ratio that banks are looking at for commercial lending, usually they want that to be 1.2 to 1. So that means that the income needs to be 1.2 or 1.25 times all of the expenses, including the mortgage that you're getting. So if the income is $12,500 a month and the non-mortgage expenses are $4,000 a month, they would lend to an amount where the mortgage payments do not exceed $6,000 a month, because the $4,000 non-mortgage plus $6,000 mortgage costs, so $10,000 total, on $12,500 in income, that would be a 1.25 to 1 ratio of income to debt. So based on that, what they're doing is they reverse engineer the amount and the maximum that you can qualify for based on this debt coverage ratio. Now, one of the questions you're asking is, well, does it matter what size loan it is as long as it meets that criteria? And so to a certain extent, yes. However, on a larger loan size, you will find that lenders do have higher liquidity requirements. And so if they look at it and you're trying to get a $10 million loan, they're probably going to want to see somebody that has a little bit more of a net worth, in particular a liquid net worth, in order to handle any things that come out of the ordinary. And unfortunately, things do come up and things happen. As an example, CMHC typically wants 20 or 25% of the loan amount in liquid assets. They can sometimes look at real estate assets as well. So if you're trying to borrow $10 million, they'd probably want to see a net worth of 2 to 2.5 million. Ideally, they'd like to see a lot of that liquid. So it does increase the liquidity that you need to have. So that's something that you do need to consider. But otherwise, in theory, yes, you could get a larger loan on the commercial side, but you'll probably need to see larger strength or larger covenant, we call it. So larger, guarantors and co-signers need to be a bit stronger in that case. Good. Any other questions? I hope this was helpful. Thanks so much for coming out, everyone. Looking forward to seeing you at the next webinar, and yeah, hope everyone has a great day. Hopefully, this war in Iran is not impacting you or your families or friends. It is a tenuous situation for sure. So hopefully, everything is going okay at home and abroad. And have an awesome day, everyone. Have a great time. Thanks.